This seriously stunned me. This is Ross Gerber, a big Tesla stock bull, and this is the biggest Tesla stock bear, Gordon Johnson. And people are saying this was a Ross tweet getting endorsed by Gordon Johnson. I am certainly not the only one that is hugely surprised by this. People are also really surprised, calling to reset the simulation. Let's see what they are actually saying. I will also dive into a report from Morgan Stanley. They say now that Tesla can actually deliver as many as 2 million vehicles this year, which would put Tesla at a little bit over 50% growth year over year, although they do expect more price cuts. So Ross says here, Tesla shareholders will have to accept the new paradigm soon. Lots of new challenges the company faces now that it has matured. Many issues are finally catching up to them. There's legitimate competition and it is real. And Gordon Johnson says, wow, truth from Ross Gerber. So are you saying it shouldn't trade at 100x forward EPS? Yet maybe something closer to 7.4x as the rest of the auto industry does. Stocks don't trade based on what the industry standard multiple is. They trade based on how much growth a stock is expected to have, how much the company is expected to earn in the future, and how fast will the company get there. Also, are you still saying you will never sell a share of Tesla stock ever? And are you willing to admit FSD is a scam? That's a lot of loaded questions there. Let's see how Ross Gerber responds. Hopefully, he doesn't go fully to the dark side. I mean, after all, he does own quite a bit of Tesla stock, and he is a Tesla stock bull still. And by the way, Tesla does not trade at 100 forward EPS right now. It trades at 50. But maybe Gordon assumes that Ross Gerber thinks Tesla stock should be double right now. But yeah, I don't think Ross expects that. He usually says that Tesla should be trading at $200, and that's the fair value of Tesla stock right now. I disagree with that. I think it should be more, but that's what Ross Gerber says. Ross responds, he says, Tesla trades at 50x EPS, which is true, and that's what it should be still for now. Tesla is a tech company that makes EVs. FSD gets better and better, and no one is close. Tesla stock will perform with EPS growth over time. All companies go through some growing pains. Good companies get better from it. Gordon then fires back with this image. Supposedly, Tesla is in the last position. This is one of their previous leaderboards. This is not the current one, but as you can see, we have Argo AI and what happened to them? I mean, they were leading the way. They were leaders. And yes, that is absolutely right. They led their way straight into what you can describe as bankruptcy. Ross had a few more things to say. At some point, Tesla might have to actually try to sell cars. That point is now. They need to start creating demand instead of filling orders. Alexandra Murr steps in and she says, so the 422,000 delivered vehicles were not sold, just handed over and that's it? Come on, Ross, this is ridiculous, says Alexandra. And actually, there is a lot of truth to support the statement from Ross. This certainly supports it. This came out yesterday. Tesla tumbled 6% on demand concerns. Tesla's stock continued to tumble on Monday after the company revealed its first quarter vehicle output and sales report, which seemingly raised some doubts about the American carmaker's ability to meet its stated delivery target of nearly 2 billion units for this year. As you can see, it's a real news source. Baja breaking news. They have a logo and everything. It's the information company, just in case you did not know. Alexander also tweeted at Ross saying, even if that would be true, speaking about the paradigm shift, does that mean you are now replacing Tesla stock, currently that is his number one holding, with Polestar, only other EV maker in Ross's fund, currently number 33. Alexander just doesn't understand why Ross is criticizing Tesla stock all day long, but keeps Tesla stock as his number one position. Ross replies to Alexander by saying, I wasn't impressed by the numbers. Tesla is a core long-term investment. I am not sure why I can't be critical of a company I own. And with that, I actually agree. If you own the company, you can be critical. You can do anything that you would like. Christian agrees with me and says, To Ross, you can, meaning be critical. I told you 500,000 though was way too optimistic, and I fully agree with that. Ross replies, I thought they would sell every car. They simply can't, even with these massive price reductions. I thought 450,000 at the least. Wasn't impressed with 422,000 deliveries. I think if Ross remembers maybe that we are launching the Cybertruck this year, I think he will probably feel a little bit better. And when the next generation vehicle comes out, I think many Tesla stock investors that are a little bit worried right now will also be a lot happier. And actually, Ross did mention the Cybertruck. He is quite excited about it and he wants it to come out as soon as possible. And now let's take a look at Morgan Stanley's report. They think that 2 million deliveries this year are in sight, but perhaps more price cuts are needed. Morgan Stanley points out that Tesla's inventory is indeed still very low. Right now, it is at about 16 days of supply, which is much lower than the industry standard, but they say that's the highest for Tesla since the second quarter of 2020. Then they point out that currently the production rate is already at 1.76 million units per year if we analyze the production rate of the first quarter, and they think that 1.9 to 2 million units certainly achievable, but the question is at what price and margin. Are more price cuts needed? Well, Morgan Stanley says Tesla Q1 deliveries increased 4.3% on a sequential basis compared to Q4, despite continually higher production capacity, substantial price cuts, and pent-up demand release related to incentives in the US. They make it sound not great for Tesla, but I would also like to point out that in the first 2 weeks in the US, the demand was a lot lower because the prices were still absurdly high and there was no $7,500 EV credit yet. So I can also say the opposite of what they are saying here. Given the slowing economic environment, increased pressure on financial institutions' willingness to lend, and competition, BYD and others, we believe Tesla and its EV competition may require further price cuts to achieve the higher end of consensus volume expectations this year. As we have written for some time, we believe it is Tesla's objective to lever its cost advantage in the form of lower prices relative to the competition over time. We are of the opinion that without the aggressive price cuts, Tesla sales may not have grown on a sequential basis, a sign that even the most dominant EV player is not invulnerable to a slowing macro and competition. Well, that's a rather obvious thing to say. Obviously, if interest rates keep going up and up and up, that's the same as increasing the price of the vehicles. Of course, that will have some impact. So will Tesla's gross margins hold up? During Q4 results, Tesla management expressed confidence in keeping gross auto margins at a minimum of 20% excluding credits each quarter this year. If they can do that, that would be a great achievement. Our own forecasts for 20.5% clean auto gross in Q1 and 21% for the year are consistent with this, albeit below consensus expectations. At the same time, we encourage investors to consider how the environment has changed since Q4 results, including further signs of competition, particularly in China, stress on the banking sector, and other factors. Then Morgan Stanley talks about the lack of a captive subsidiary. With leasing penetration of just 5%, we remind investors that Tesla is one of the only major auto companies without a captive finance subsidiary, meaning then you buy a Tesla vehicle, you get a loan from a bank, for example, not from a Tesla subsidiary, which right now that's good, sort of, because if Tesla cuts down the prices of the vehicles, then it does not have to take that hit. If all of a sudden consumers owe more money to the bank than there is equity in the car, that's really bad for the lender. But Tesla does not have to take that hit, so Tesla can just cut the prices as much as Tesla wants without having any real issues here. Given market concerns around FinCo exposure to deteriorating auto credit, particularly in subprime, and potential residual value risk, which is what I just talked about, This may be a good thing. At the same time, however, if third-party consumer finance companies were to pull back on lending attitude into a slowing economy, Tesla would not have the same tools at its disposal to adjust the monthly payment for greater accommodation. In our opinion, the lack of a subsidiary can protect Tesla in the event that the average prices of its vehicles fall substantially as EV technology changes on a generational level, with many of today's EVs facing a degree of obsolescence risk, says Morgan Stanley. I think Tesla will eventually get into financing as well, but that does not need to happen right now. But when it does, I think it will be a good decision. Right now, though, Tesla not being involved in it is actually benefiting Tesla. This happened last week, but I did not cover it yet. Elon Musk officially now has the most followers on Twitter. And this is the Tesla stock buying opportunity explained by Elon Musk. My name is Matt Posius. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.